Welcome. In this phase, we will learn about quantitatively valuing a company, the crux of the equity analysis of any company. The objectives of this module are to cover the concept of time value of money, the various types of valuation prevalent in the industry, and give specific focus to the capital asset pricing model. It is first important to understand the concept of time value of money. This concept is based on the common sense thought that money available in the present has a different worth than the same amount available sometime in the future. For example, the worth of a 100 rupee note right now is different than the worth of the same note 2 years back, and it will be different than the worth of the same note 2 years from now. This always holds true as long as interest rates remain positive, since that means that the money has earning potential as time progresses. Any rational investor would prefer to receive the same amount as early as possible. In light of this, we define future value and present value. Future value, in simple terms, is how much your present money will be worth in the future. We use a simple compound interest formula to get to the mathematical expression. Future value equal to present value into 1 plus r to the power n. The rate r is called the interest rate or discount rate. Likewise, we would like to know what will be the worth of future payment to us today. This is called the present value, and this tells you the present amount that is equivalent to a certain future payment. Just playing around with the compound interest formula, present value equals future value divided by 1 plus r to the power n. This activity is called discounting the future value, and you will hear a lot of this phrase discounting the future value in this lecture and your forays into finance. What is valuation? It is the process of finding out a company's true worth and using that to determine whether its stock is worth buying or not. In finance, there are two different types of values. Market value is the current quoted price at which investors buy or sell a share of the common stock. The price at which a share of the company is selling at on the stock exchange is called market value. Intrinsic value, on the other hand, is what the share is actually worth, including all aspects of the business, tangible and intangible. Obviously, markets aren't perfect at times, not even close. Hence, the intrinsic value may differ from the market value of the share of a company. Now, the end result of equity research is to make a buy or sell or hold recommendation on the stock. To do this, we evaluate the intrinsic value of a company's stock, compare it with the market price, and make a suitable recommendation. To make this crucial call, we follow two standard and logical rules. If the market value is greater than the intrinsic value, then the stock is overvalued and it should be sold. For example, you have something that is selling at 100 rupees but is actually worth 70 rupees. Then we presume that the item will move towards its actual price. So to avoid incurring this loss if you hold on to that item, we sell the item. Similarly, if market value is less than the intrinsic value, then the stock is undervalued and it should be bought. So valuations are a very important tool to ensure profitable and smart investments in the stock markets. Simply put, it is necessary to know about valuation techniques if you want to put your money in the right company at the right time. Now there are plenty of techniques of valuation. Some are even customized and trademarked by companies. But there are two broad categories that we can classify valuation under: relative valuation and absolute valuation. What's the difference between the two? Absolute valuation attempts to find the intrinsic value of the company based on its fundamentals and gives an exact value for the worth of the company. Models like dividend discount model, DCF model, etc. come under absolute valuation. On the other hand, relative valuation looks at a company's worth vis-a-vis its competitors and involves financial ratios like the ones we had discussed earlier. Here, an exact worth of the company is not arrived at. DCF or discounted cash flow valuation is based on discounting future free cash flow projections to the present to arrive at the value of the company. Free cash flow can be either to the firm or the shareholders. FCFF, which is free cash flow to firm, and FCFV, which is free cash flow to equity. FCFF is the cash flow available to all investors in the firm, both debt and equity holders. On the other hand, FCFE is the cash flow available to only equity holders and is arrived at by subtracting the after-tax interest from FCFF and adding any cash from taking on debt. The dividend discount model is a technique for valuing the stock by predicting expected future dividends and discounting them to the present to calculate the worth of the stock now. However, this doesn't apply to firms that do not pay regular dividends, and it also has many variations on the intricacies of the model. Now there is one very important yet simple prerequisite that we need to understand. That is the capital asset pricing model, also called the CAPM model. Mathematically, this is RE equals RF plus beta into the difference between RM and RF, where RF is the risk-free rate, RM is the expected return of the market, and beta is the beta of the security. The CAPM model helps describe the relationship between risk and expected return. It is based on the premise that investors need to be compensated in two ways: the time value of money and the risk they are taking on. RF represents the time value of money component, and beta plus difference of RM and RF represents the risk component. Let us consider each term of this formula. Risk-free rate, as the name suggests, is the rate of return of an investment with zero risk, the minimum return an investor expects from any investment. To find this value, the yield to maturity of government bonds are used. These are considered to be risk-free because the likelihood of governments defaulting is extremely low. To find the value of RF, follow the steps described here. Here we have taken the example of a stock listed on the United States New York Stock Exchange. So hence we are calculating the value of RF with respect to United States. First, visit the US Department of Treasury website, that is treasury.gov, and navigate to Daily Treasury Yield Curve Rates page. Or just Google US Treasury Bond Yield and visit the treasury.gov link on the search results page. Next, select the current year under time period and click on Go. Note the 10-year yield for the first date in the table displayed, which is usually among the first few days of January. Next, repeat the same for the prior 2 years by selecting them under time period and noting the 10-year yield for the first date. Now average these three recorded values and you get the RF. The next variable in the CAPM model is RM. The expected return of the market is estimated by measuring the geometric average of the last three returns on a market portfolio, which is usually the index of the stock exchange where the company you are analyzing is listed. Practically, the RM value can be found similarly as beta and RF on financial news websites like Reuters.com and Bloomberg.com. Also note that the value of RM minus RF is called the risk premium. Beta measures a stock's volatility with respect to the market, given the present economic scenario and the company's financial stability. It shows how much the price of a particular stock jumps up and down compared with how much the stock market as a whole jumps up and down. Obviously, the more the volatility, lesser the stability. Mathematically, beta is the slope of a line drawn between the daily share price returns and the market daily returns over the same period. So if beta is less than 1, then the stock is less volatile and more stable than the market. On the other hand, if beta is more than 1, then the stock is more volatile and less stable than the market. For example, a stock with a beta of 1.5 would possibly rise by 1.5% if the market rose by 1%, and it would possibly fall by 1.5% if the market fell by 1%. As mentioned earlier, practically, the beta value of a company can be found on financial news websites like Google Finance, Reuters.com, and Bloomberg.com. So we plug in the values of the discussed variables RM, RF, and beta in the formula for CAPM and estimate the value of RE, the cost of equity. Now let us look at the entire process of valuation in one snapshot. The first step is to obtain the historical income statements of the company. Then forecast the sales of the company for the next 3 years. This is done after a thorough study of the company's official directors' reports, investors' reports, etc., and recent news items related to the company's products or services and its market. After that, forecast the remaining items of the income statement. To forecast the expenditure items, make use of concept of fixed costs and variable costs. To account for earnings of the company post third forecasted year, calculate the terminal value of net income. Estimate the terminal growth rate G, which is the constant growth rate the company is expected to show in the years beyond. Terminal value equals forecasted earnings divided by the difference between RE and G. Assume the number of shares outstanding remains constant over the forecasted years. With that, calculate forecasted earnings per share EPS and terminal EPS. Discount forecasted EPS to the present by using RE from CAPM model as the discount rate. Finally, calculate the target price of the stock as target value of the stock equals the sum of discounted forecasted EPS. If market price is greater than target price, the recommendation is to sell the share of the company. However, if market price is less than the target price, the recommendation is to buy the share of the company. Do not worry if you have not followed any one of these steps. They will all be explained by using an example in the next lecture. This brings us to an end on the lecture on valuation. In the next lecture, we will consider the live valuation of a real publicly traded company, Google Inc. This will act as a guiding light for your own assignment. Please note that if you have any conceptual or assignment related doubts, feel free to send an email to eri@mentored-research.com. If you have an emergency and are not able to complete your assignment on time, then send an email to support@mentored-research.com and we will try our best to give you a deadline extension. In case you are having any technical issues with regards to accessing your account on the portal, then send an email to tech@mentored-research.com. All the best.